All right. Thanks, everyone, for coming and bearing with us while we get set up. Returners, you're obviously probably wondering a little bit what's going on. This is the first time we're trying to set up a real recording to put it online for people so everyone can watch it afterwards. People who aren't here can watch it. We can get some clips together and throw it up on social media, on email marketing, stuff like that. So we're trying it out. If there's some loud noises or stuff, please just bear with us. This has been a steep learning curve for me especially. We also wanted to bring in two guests to kind of do a quasi conference, panel, Q&A type thing. So we're going to focus mostly on the difference between small and large multifamily. Everyone here has either invested in personally, sponsored, run, been involved in, as small as single family to as large as 200, 300, 400 unit properties. So we have a pretty good gamut of experience in different areas. So I think it'll be pretty good experience for everybody. Why don't we just start? Chris, you want to just give a little background on yourself? Make sure you speak into the mic so it picks it up.
Sure. Chris Jackson, Sharpline Equity. I've been investing for about 10 years. Have about 300 units now. I've syndicated deals. I've wholesaled single-family houses. Just sold an 8-unit. We've syndicated a big 174 unit, raised $4.5 million in a month. So I've seen it all. And just recently with my sale of the 8-unit, I've been working towards this for a long time, but I was a tech guy for a very long time. And been working towards this for a very long time, a 2-year transition, one foot in, 1 foot out with both companies. And as of last week, I'm a full-time real estate investor. So that's pretty awesome.
Congrats. Nice. Congrats. Yeah, there we go. Clap it up.
Thank you.
Good stuff.
Chris also has a meetup that's very good that you guys do once a month.
Yeah, self-promote.
It's Multifamily Unveiled. It's the second Wednesday. It's actually right in Garden City. Second Wednesday every month, Multifamily Unveiled.
And what we'll do, too, just if everybody, if you're on the Meetup group, we'll send an email out afterwards with the link of this, their contact information, their stuff. So if you want to get in touch with them, if you don't get it tonight, we'll send that out afterwards. But Josh, you want to?
Do you have a sign sheet?
No.
Oh, okay.
Josh Eitingon, DXE Properties. So we're a real estate investment group similar to Chris's. Our focus is primarily multifamily, although we do have some experience on the retail and condo development side. Right now we have about 300 multifamily units under management. We've done about 500 units total. My background was in the software space, then on the acquisition side, and about 2 years left that company to go full-time here with DXE.
And Josh also has you also have a group that you do.
I do. I wish I could say it was monthly. It's a little less frequent, but we do a quarterly meetup, just different topics. Long Island, Westchester, New York. So similar type of thing.
There you go.
Thank you.
Most of you guys know Chris and myself, Toro Real Estate Partners. I'm co-founder. I started investing in real estate really right out of college. I started in a single family, buying a lot of tax delinquent properties in Philadelphia. That's really where I learned everything, good and the bad. The transition for me, I was working as a stockbroker, got a job at Morgan Stanley, quit that job, started on the real estate side to be a real estate investor, realized that you don't really make money right out of the box. So I just got my real estate license, started working in the city, doing residential sales and rentals. Then I worked at Marcus & Millichap doing investment sales, multifamily investment sales. And that, parlayed into the full-time owner-operator of multifamily properties, throughout the country. Midwest, Southeast, and our largest property is 450 units. Our smallest property is a duplex. So we have a wide gamut in there.
Yeah. Go ahead. Not sure he deserves it, but we'll give it to him anyway.
Definitely don't.
Like you said, I'm Chris. I work at Toro underneath John. I started there back in August 2016. Before that, I worked as a stockbroker. I was a coach and just trying to find my feet. I'm 27, so I'm still relatively young, especially looking out in the crowd. A little bit of a different perspective. And definitely compared to these guys over here, I definitely see some gray hairs as I'm looking down the line. So it makes me feel better. But no, I've been working at Toro for almost 3 years now. Since then, we've bought a little over 2,500 units, 2,700 units. It's evolved into a role where I kind of handle all the Florida assets and then help out where I can. And it's started, involving a lot of the marketing stuff in the past, call it 3 to 6 months. So that's why you saw me for the past 45 minutes putting all this stuff together. In that role, we're really trying to just reach out more than what we've done. We've been doing the Meetup for almost 2.5 years, and it's gone pretty well, and we always have a very similar crowd. But if we can put this out there and bring it to more people, we're happy to do so. So just taking a larger role in that, very similar to John. 400 units to a duplex. I've been involved on both kind of the sponsorship side and working under a slightly larger company side, so I can give a little bit of a better indication on two sides of the same coin kind of take. And just happy to answer any questions at the end. I'm going to try to moderate this as best I can, but really I think the best use of our time is going to be to do a couple questions, get some stories, the good, the bad, the ugly, talk a little bit, but then really open it up for Q&A, because oftentimes you guys will pull out questions and get better information than I will asking questions, because it's stuff I don't even realize you guys want to have questions. So we'll see how long it goes. I would say probably 30, 45 minutes, keep it short. Open it up to Q&A, maybe 20, 30 minutes, and then we'll just do networking at the end. So, meet amongst you guys, come up, introduce yourself if we haven't met you yet. Come say hello if we know you really well, just see how things are going. But I think the best way to start, we started just kind of saying small and large multifamily, and I think that's kind of a gray area, right? When does small start? When does large start? So Chris, I'm going to put you in the hot seat first.
Sure.
For you, I know it's probably a gray area, but what is that real transition from small to large? And is it a dollar amount? Is it unit amount? Is it market specific? How do you see that?
I think small to large multifamily starts at I'm actually going to call it 3 steps. I think that you go into 20 to 30 unit, and that's going to be very different than, I think, 70 unit, and then once you hit 70 unit, I think over 150 units starts to get different. But so I would say if you want to think about small multifamily, I think that when I think of small multifamily, I think of 15 units. Large multifamily, I think of as I do think a 50 unit is a large multifamily, but I do think that is different than 100 plus.
What is it about the difference from 15 to 50 that changes it in your mind?
I think things get more, obviously you need more equity. The equity just starts to go up, and you just need to have your relationships more dialed in with your ability to raise money. I think that you can pull it off with a couple people on the smaller stuff. But when you start getting into the 50 unit zone, you really have to have your capital raising dialed in, so that it becomes more of a skill set that you have to develop over time. And then I think from the operational perspective, 50 units is more templatized. You become thinking about efficiencies a lot more. You can't even achieve efficiencies really in a 12 unit. You get it right 3 times, but then you can't exercise it that many more times. When you get into a 50 unit, you can say, hey, we figured this out 10 times, now let's go do it 40 more times.
Gotcha. Josh, how about you?
Yeah, I think I agree with a lot of that. For me, I think it's operations driven more than dollar amount. I know there's a lot of, all of us on the panel here use third-party property management in some way, shape, or form. Some of the larger managers, they won't touch a deal that's less than 100 units because they want to be able to staff it with a full-time maintenance person, full-time office manager. Otherwise, it's just not worth their time, energy, and effort. So, you get your investors that are looking at those deals that are just a different profile than on a 30-unit deal, where it could be maybe a husband and wife or an individual that's buying that deal, managing themselves, or buying that with a few others and have a local handyman guy that's jumping around. So I think there's that line. And then there's the 200 to 250 unit plus space, which often puts the equity check more in the $5-10 million plus range, where you do have some sort of larger private equity or institutional equity type competition.
Great. John?
Yeah, I would say the only thing that was obviously market dictates it as well, because you could buy a 6 unit in New York that's going to cost just as much as a 50 unit outside New York. So is that a big or a small multifamily? I think that's relative, but I agree 100%. the sub 50 unit space. The first property I bought was 48 units on the multifamily side. When I sat down and I really looked at the business and what I wanted to achieve, I thought that was a big deal. I said, okay, it's not a 400 unit, but it's not 10, which most people, I think, anyone would say, how am I going to go buy a 20 unit first? But, I picked a price range, and because I knew where I'd be able to raise money, knew where I'd be able to get it financed at. So, I would say just like them, 50 units, sub 50 units is probably on the smaller side. I never thought we'd be buying 300 and 400 unit properties. I don't think going forward we would either, for the simple fact that it's harder to have everything going on. Even your third-party manager, 400 unit property of 40 leases rolling a month. So there's always something going on. I think the sweet spot for us and what we've done very well and executed extremely well is in that 120 to 275 unit space. They're deals that run really smooth. I think there's less competition from significantly larger investors that'll take less. So that's a sweet spot. I would say that's a mid to large size, and then north of 250, like Josh said, I think that's really when you get into a different space.
So safe to say all of you blend between operations, dollars, and actual units. Kind of a market specific depending upon where you are, and very different from Brooklyn to middle of Kentucky, correct?
And I think also, Josh, you touched upon it, was like that 70, 80, and it starts to get into a gray zone, but like where you can afford more staff. Like we have a 60 unit and we have a one person on-site staff, but it happens to be a good handyman and a good leasing person. That doesn't always work out. So that's why when you get into the higher units, like that 90, 100 zone, you start to be able to have two people where it makes sense. So that's where I've noticed the difference also.
Yeah, that's a great point, because the inefficiencies in like the like 100, 170, because you're like a tweener between 2 full-time, 4 full-time, and that's where it gets, on an owner's side, I want to lower the expenses, and I don't want that extra person there, so we try and, I'm always pushing back, like, do we really need that person? The answer is yes. Those deals typically run a little bit more expensive. If a broker's selling you that deal, they'll discount that completely. But I agree, it's those tweeners where you're just below what would really make sense for a full-time in-house and a full-time full-time leasing agent, full-time maintenance person. That helps significantly on the operation side, from day-to-day operations and making sure everything's running smoothly.
So just to clarify something, whoever wants to take this, can you explain the different payroll and management fees as you scale up? Because I think we might be losing a couple people that may not understand.
Yeah, that's true.
Just kind of clarify the staff, how that works, so they understand a little bit better.
Definitely. So I think a lot of people in this room, probably various experience levels or desires on the real estate side. I would definitely suggest anyone getting started in real estate, if you're not living in that property, to use some sort of professional management, just in general. But what you're going to see on the fee side is you'll see a few different tiers. So for a single family, 2 family, even sub 20 or 30 units, it could be as high as 10% that a property manager is charging as a percentage of
what? Oh, yeah.
As a percentage of rents collected, paid monthly. So in addition to that, they may also charge a lease-up fee. So if they lease a new unit from a property, they're going to charge maybe $500 for that unit, or even up to a full month's rent. So those are additional fees that you're not going to see when you do have full-time staff. So if you're in the, like you said, 80 unit space where you have a full-time office manager, a full-time leasing person, your leasing person's going to be leasing those units, and it's going to be much more efficient for your property management company. So even for a smaller deal, like you said, it's Snapwoods is what, 70 units?
It's 56.
56 units. Okay, and we had a 70 unit deal. So the 70 unit deal, we paid 5% as a property management fee, but the salaries were passing through at the property level directly. So we were covering the salaries in entirety. And then as the deal size scales up, you'll typically see property management fees drop down into 3 and even sub 3%. Like on your largest deal, you're probably sub 3% or right around 3.
Yeah, around 3.
Yeah, the 174 unit has 3.5% and so 174 units, 3.5%, and approximately $200,000 in salaries paid out by the property.
Yeah, so we don't employ any of our on-site staff. The third-party management company employs them but you pay out of the building's operations all the, their salary, their bonuses, their, all that stuff comes out of the property. So you collect your rent, the manager gets their fee, and their salaries get paid directly out of there. So it's not a physical expense outside the deal. It's a deal cost, but on the bigger deals, the deals pay it directly. That person's full-time employed at that property.
On the larger properties, I'm curious what you guys are seeing, but we used to run a calculation that was $1,000 per unit per year. Approximately, you have 150 units, $150,000 in salaries. That number is going up. I think we're probably all is at around 11 to 12 at this point. 11 to 1,200 per unit per year.
Yeah, market driven for sure.
Market-driven.
But I mean, we have some properties at $1,300, $1,300 a unit. And it goes both ways. You always want to maximize your expenses by the cheapest way or the cheapest alternative. At the same time, a property will make or break, and I think everyone up here can speak to it. If you have poor on-site, you can have the best third-party manager in the world. If your on-site's horrible, the deal's going to struggle. Leasing's going to be bad, maintenance is going to be bad. Mm-hmm. So sometimes we'll look to do it in other areas because you want a great staff.
Yeah, I mean, I think each deal is like its own little mini business where if I'm going to overpay on something, I'd rather overpay on people. I think a lot of small business owners just around here, it's probably the same thing. It's just difficult to find good people, especially in this environment as well, whether on the maintenance side or office manager side. There's a lot of opportunities out there. So if you can get someone that's good and you can keep them, I think you try to keep them.
So at what point would you consider switching from off-site staff to on-site staff? At what number of units?
So no problem with the question. Just when we start doing questions, I'm going to repeat it just so we have it in here. So the question was, at what number of units do you start bringing in on-site staff versus just third-party management fees paid out where there's no dedicated on-site staff?
I'll give the bad answer of it depends. Yeah. If your average rent is $2,500, probably a significantly smaller unit count, or those tenants may be more sophisticated. Not to, talk poorly about less average rent, but I think the safe answer is probably in the 100, maybe 80 unit range. We had an 80 unit in Charleston that we had full-time maintenance, full-time leasing agent. It was expensive. It was super expensive. The biggest fight we had with our manager, but did the deal support it? Because you think, what could possibly go on day to day that person has to work there full-time? There's just things that you probably wouldn't even think about. My number, I would say once you start touching that 80, 90, definitely 100.
We have a full-time for the 56.
There you go.
But and it's a high salary. Okay, so it hurts the property, but it helps it. We have great numbers because all the tenants are taken care of. Leasing comes in. But I mean, if the person wasn't that great, it would or if we say we took away the salary, made them part-time, I do think the numbers would suffer on the property.
Mm-hmm.
Yeah, it's an interesting space, that in-between space, because I mean, I think you could run very, very efficiently and distinguish yourself from another operator in a way that you just might not be able to for other deals. I mean, we have 62 units where we have 2 full-time employees, and it's probably one of the better deals that we've done. So I don't think there's a right answer. I think to John's point, if you have $2,000 a month type of rent, you may just have a tenant base that expects someone there full-time as receiving packages and all those things that you're not going to have in a $600 unit type of rental.
Yeah. For me, it's when you're in that kind of tweener space, you've got to look at the actual dollar amounts that the property's bringing in. If you've got 80 units with a $300 rent, it's never happening. If you've got 8 units with a $10,000 average rent, it might work. So you've really got to look at also, when you're in that middle space, what's the dollars and what's the salary somebody needs to work there, and then you can kind of back into the per unit. If you want somebody there, just underwrite every deal with salary there and buy the deals that support it. If you're okay with not having it, then don't have it. So in that tweener space, it's always a little bit different. We talk about it all the time. We buy exclusively out of state. I don't know if that was mentioned. We're in all different areas in the Southeast and Midwest between the 4 of us. We get outbid on 50, 60, 70 unit properties all the time because there's a local professional who makes $200,000 a year that is willing to manage it himself or to not take a management fee and oversee one person at the property. So we underwrite with an 80 unit having, an on-site manager and a maintenance person, and that's going to cost us $80,000, $90,000, $100,000. That person may be able to do plus a management fee. So you're at, $120,000, $130,000 for a management company and on-site staff. They may be able to do it for $50,000. They're going to be able to pay more for that property 10 times out of 10. So when you're in that tweener space, you just got to underwrite with whatever you want there. And if the deal supports it, great. If it doesn't, you got to move on. I think where we should go next is let's start with, smaller properties, right? Single family, duplex, 10, 15, 20, 30 units, whatever you consider small. And let's just kind of talk, a couple of deals you've done, highlight them, how many units, where it is, why you liked it, why you didn't like it, and let's talk pros and cons.
Of the small units.
Yeah, let's start small, and then we can talk pros and cons on the large stuff. So, Chris, why don't you kick it off again?
Yeah, I have a bunch of single-family homes. I have about 40 single-family homes in upstate New York. The cash flow is really good on a lot of them. Some of them are total turds. And we are jettisoning some of those. But I think that I kind of came up through the multifamily space, and then I was trying to apply a multifamily lens to single-family investing, and I just couldn't scale it. I just could not scale it. Then we bought a 60 unit, and then we went up to 174, and I probably won't go back to single families again. Even though the cash flow is good on the ones that are fantastic, I can't spend the time when I know that the same energy can go get a 200 unit or a 150 unit.
So a little bit more specific
Sure.
of things you do like about it, things you don't like about it, and if you can relate that back to, specific stuff in the,
The things I don't like
Do you
about
have
it, there's
questions?
transactional. You have to spend the same energy in the transaction of purchase. And there is a lot of complexities that go on in big multifamily, but you figure it out and you spend your energy there and you solve a big problem. On small single families or small duplexes, you're surprised by this level of brain power that you're putting on a duplex when you compare it to the brain power you put on a big unit. I also think you end up, with 30 single family homes, I would say that I've seen it. I can't find a templatized solution. There's a different problem for every house.
Why do you think the brain power is the same or less for larger?
Because once you figure it out, you can there are different pieces of it that you have to figure it out, but you pull it together and you've just done a multiplier. 174 units. Yeah, was it the same as one single family house? No. Mm-hmm. Was it the same as 20? Probably.
Mm-hmm. Okay. Josh, how about you?
Yeah, I think depending on your desire, just on the investing side, I think everyone has to start somewhere. So not everyone can jump in and buy a 80-unit deal because it's going to operate more efficiently. So I think that on the pro side, you could definitely separate yourself from local buyers. Maybe you're able to show proof of funds. Maybe you have a really good track record, to secure financing or something to give you a leg up from some of the local investors there to be able to buy at a more attractive number. I do think with a very strong property manager, there's much more operational issues that come about on the smaller deals. So you're more likely to find opportunities from mismanagement, from just significant issues that you're more often not going to see at a much larger scale. But my first two smaller deals were in pretty rough areas. So if I learned anything on the smaller side, it's that I would definitely not do a 20-unit deal in a predominantly Section 8 type of location. It's just you're not getting the attention from full-time staff. You're getting scattered site management, meaning a property manager's at this property, then another one, bouncing around. So, if it's going to be a smaller deal, to me it's location as the most important thing.
Okay.
Yeah, and I think that they touched on most of it. We have some smaller deals as well. I think the quality of manager a lot of the times is a little bit tougher. Their systems IP is good. If you have a really good manager, it works. If you do the physical math, what is their fee on a duplex? It's hundreds of dollars. Right. So they need so many properties under management to pay the bills. So it's almost like a numbers game. So things can fall apart. That's probably the biggest negative from my standpoint. A pro though, like Josh saying, not everybody can go buy a 200 unit property because it's more efficient. It is more challenging. There's financing hurdles, there's equity raising, there's SEC stuff. There's a lot of challenges there. So I think it's the first thing you have to do is look in the mirror and see what you want to accomplish, right? There are plenty of single family houses that you can buy that can give you a little bit of money that people are extremely happy with. And it could be down the block and you can do a lot of the work yourself. You put a tenant in there that never leaves. But those pros for us or for myself, it didn't weigh out. It was, it's a one-off deal that, could be okay. Maybe it's something that you just want to do on the side. That's probably the pro is it just, maybe it's your personality, it works. But the negatives for us far outweigh it. You're just dealing with a totally different everything. So that's a biggest challenge for us on the smaller side.
I mean, having said that, I had an 8 unit that I owned for 10 years. I refied it, just sold it. It was a total pain in the butt, and I just totally crushed it. So like, we're complaining about a small unit. It just time healed everything, and it's totally crushed it. So I think it's also about sticking with it. Like, I'm not going to say that like don't do small units. I just did small units, and it worked out well.
So I think all three of you, no offense, kind of strayed towards the negative because we've all been there, had our troubles, and have scaled up because we've had the ability to scale up.
One more positive. I'll give you a positive.
Yeah, on the small stuff. So Chris, because you're just talking about that 8 unit,
yes.
I know you said time, but what is some of the stuff that did go well? Or let's say it wasn't out of state, right? Let's say it's closer. What's a pro that you could see from smaller stuff?
I mean, the multiplier. It's a negative. I'm going to turn it into a positive. The multiplier of things that go wrong, you can attack it. Like if you miss per unit something that's $2,000 on an 8 unit, come up with 16 grand. $2,000 on a 200 unit is $400,000.
Yeah. Oops.
So there's that piece. You can get control of it.
So your expenses get out of control a lot quicker. The multiplication of it is both a pro and a con, in your opinion.
In the larger ones, you have to be careful. Yes.
So I think it's also to his point. I don't want to put words in your mouth, but it's if you make a mistake on a 4 unit or an 8 unit, the operations might suffer, but you could catch up. Mm-hmm. If you make a mistake on a 200 unit, you may never catch up. It may hurt significantly more. So that's definitely a pro in my eyes. Is 16 grand's a lot of money, but it can be made up, from your regular job and saving a couple dollars and fixing it. It's very difficult to make up $400,000 if whoops, all the HVACs are gone, right? Like, what are you going to do now? Like, now you have a totally different issue on your hands. So I think it's easier to overcome a challenge, just your own money in your pocket. And you may not overextend yourself on a small deal because you may be nervous and you might buy a smaller deal at a better price and you save some more money. And, you save some more money that you have a little bit of a reserve. It's tough to buy a 200 unit with a ridiculous reserve. You're probably not going to be competitive if you try and buy it.
And in at smaller units, you don't necessarily have to partner as much. And like we all like partnering, so that's not an issue. But like if that's something that you don't want to do, you can go in that small unit space and not have to partner. But when you get into the larger, you are partnering up, which we all I think is a positive.
Yeah, I mean, us here, we all took sort of a business type approach to this. So we are trying to scale, and we appreciate the efficiencies of size and all of those things. I will say, as an entry point into real estate, for people that come up to me that say, hey, how do I start? What's the best way to go? To me, it's if you don't own a home, buy a 2-family, 3-family house. You can get very attractive financing, live there. It's probably your safest starting multifamily real estate investment.
House hack.
And sort of rinse and repeat. And sure, it's not going to build you an empire overnight, but I think it's a great like get rich slow type of a thought process. So that you're not going to get by buying a 80 unit deal on the other side of the country.
Correct. I think the other thing, like you said, if you can go buy a small deal, 3 people in this room could come together and buy it. And there's examples in here when we network, talk to people, but it's go buy a couple deals with a couple friends, and you don't need to raise a ton of money, and you can do that. That could be a pro. It's a pro for me. I mean, we have 2,500 units under management, and I would definitely go buy a small deal with a friend where they take over control, and I could just throw my 2 cents in. But it's 3-4 guys come together and buy a smaller deal, and a smaller deal could be 80 units, it could be 30 units, it could be 4 units. It doesn't matter, but that's definitely a pro. You don't have the reporting, the investor relations, the headaches. You send a distribution out, no one's happy when they get the distribution, and then no one's happy when you don't get a distribution. Like that, you don't have to worry about if you go buy with a buddy of yours. So that is definitely a pro for sure, which could be done on the bigger deals too if you have that ability to do so. So there's definitely a lot of pros. I think we've all seen the negatives, and you always hear the negative stories, but there are just as many pros as negatives.
I think a couple of the other things that weren't touched on, pro for me is the inventory, right? There's a lot more inventory in single family homes, small duplexes, quadplexes, 10 units, especially in New York. You go to Brooklyn, Queens, the Bronx, the whole city, you've got tons of smaller buildings where you could easily find a 3-family for sub $2 million or something like that, or you can find a duplex for a couple $100,000. You can go out and put less of a down payment on if you don't have the capital, as well as you have way more deals to look at. And I think also your buyer pool you're competing against is significantly less educated the smaller you get down, right? We're competing against groups that have $2 billion under management on 200 unit properties, where they're going to have way more efficiencies than we do, where if we were to step down into that 20 unit, 10 unit, 5 unit space, you're going to have better knowledge than the person there. You're going to make smarter purchases in that regard. You're going to waste less time on bad deals. So I think also the knowledge that you gain will help you have a competitive advantage in the smaller space. I think one of the cons that hasn't been touched on is the debt side. When you get over 5 units, you step into commercial loans. The broad difference is commercial loans, they kind of don't compound on top of each other. So if anybody has a residential loan, debt to income ratio comes into play, where a commercial loan, you really just have liquidity and net worth requirements. So if you can go out and get a $2 million loan, you can basically go out and get 10 separate $2 million loans, where if you could only get a $2 million loan for residential, you couldn't go out and get 10 $2 million because it adds up to $20 million of debt. So it is easier to scale up when you get over 5 units because of that. So that's kind of a con under 5 units when you're still on the residential side. And then one I think we kind of all touched on, but I want to put it together, just really the barriers to entry. The smaller the properties, whether it's dollars, units, whatever, it's just easier to get into. You don't need as much money to kind of get into it. Do you have a comment, Chris? Or?
Yeah, I was going to say, I think that, I think you can find great deals that are under 50 units right now. That 20 to 50 unit space, if you really, you can find the good manager, you're willing to show up there and be present, those properties are going to be run by mom and pops, and they may be inefficiently run. You can apply more of a business approach to them. Maybe the owners just kept rents low because they just wanted high occupancy. They don't really care. There's no debt on the property. So you can find more motivated sellers, if you will, even though this is a hot market. But like in the 100-unit space, it's usually run by a professional property management company, so you're not finding the mom and pop owners as much. So I think there's an opportunity there if you wanted to hit the 20 to 50-unit space. Yeah.
And how would you best go about sourcing those deals? Just through brokers?
Brokers, direct mail, cold calling.
So just the question was how to source those deals.
Yeah, there's everybody here can talk about each one of those, but brokers is going to be your main. In the small unit space, I think you could actually see more success in the direct mail approach. Yeah,
direct mail and cold call, underutilized tools. I think that the reason why is they're a pain in the ass. People don't want to do it. So if you do it, you have success. You need brokers. I don't care what anyone says. They're going to help. You need them. But direct mail, cold call, trying everything. The one thing that is consistent across the board, I've stolen this from someone that told me, you're not going to wake up with a deal at your front doorstep. You got to go get it. So whether it's brokers, cold calling, the tax office, there's a million ways, but you just got to try it. But the 3 big ones by far, brokers, direct mail, and cold calling.
Other property managers?
That's great too. Property managers, looking at property managers' company. and seeing which ones are the deals that look poor. So if you're talking to managers and you're interviewing managers and they show you deals, don't look at the deal where the grass it's beautiful, because that whether that owner is a really good owner and lets her or him do their thing. Look at the deal that looks not good, and maybe you call the manager and say, hey, what's going on with this one? They think this guy would be willing to sell. So property managers are a great tool as well.
And sorry, Josh.
No.
Go for it. Go for it.
I just to add on to those, I would say industry professionals. I've seen at least a few deals through either accountants or attorneys that deal with real estate that just know a story and have worked with you before, and they may be inclined to at least show you that deal.
Commercial plumbers.
Yeah.
Electricians.
Yeah, find the people that are doing work at the properties and say, where are the constant eviction court, right? Go to the places where you see the same guy there every single month. If it's a market you love, and ask him, hey, there's a lot of evictions. What's the problem? Maybe it's the deal, maybe it's the market, but it also could be, poor manager, or he doesn't know what he's doing. But the professionals as well, plumbers that always go to the same property. There's a problem. Maybe the owner's tired of the problem.
All right. I think we talked on it a little bit, but let's switch to quote unquote medium or larger, whatever you want to call it. We'll say 50, 60, 70 units or more. We'll start down here this time. John, pros and cons, a couple of the deals if you want to get specific. Let's try not to be too pro.
Yeah, I would say the pros of the bigger deals are the efficiencies to run. I'll leave that as the pro. That is the best part about it. They run more efficiently. They operate themselves for the most part. Yeah, we buy a lot of deals that are messed up. Vacant properties, high delinquency, high crime. We fix the problem, so we have to put a little bit more attention in. But there are a lot of deals you can go buy 1990s, 5.5, 6.5 caps, plug and play. You really won't have a headache. The deal run itself, you get a competent manager, and you'll probably do okay. And if that's what your threshold is, if you're looking for 30% return, good luck. You find it, bring it to me. I'll give you whatever you want for it, because it doesn't exist. But there are a ton of those deals. The efficiencies are great. I would say the big negatives are the financing is not the easiest thing in the world sometimes. If you have a net worth of $1 million and you have $100,000 in the bank, you cannot go buy a $25 million deal. You're going to need a partner. So the financing is not as easy as some may seem. It's not just the building. They do look at you as well. I think that, sometimes the fear is a negative for people. Getting into a 10, 7, 5, $20 million deal, maybe a little scared. I think, a negative could be the education. You don't know what you're doing. I think that can be easily addressed. There's a million ways to learn about doing this. Free resources everywhere. Some other negatives are, you're going to have to give up control. A lot of people want 100% control. That you can't do it all. Or you could try and do it all. I shouldn't say that. You could physically do it, but you're going to have to let someone else run the day-to-day. Maybe it's the travel. That could be another, I hate getting on a plane. I do. I'm not scared of a plane. There's nothing worse than getting on a plane, connecting in Atlanta, and going to Mobile, Alabama. I assure you there's nothing worse than that. A 2-hour flight direct to Columbus or to Jacksonville, no issue. I'll do that all day, 2-3 times a month. You have to connect, and you miss a flight, and then you connect here, and then the flight gets delayed, and there's one drop of water that comes out of the air. It's brutal. It's absolutely atrocious. So that could be that. That's a huge
John, that's
negative.
actually why some secondary markets do really well, because the New Yorkers and the Texans and the Californians have to take connector flights.
Yeah, exactly. No, it's true. That for me, it's brutal. I'm telling you, go to Jackson, Mississippi. 4 times, in 3 months, you'll preach into the choir. So that to me is a huge negative. It's, I can't buy a 200 unit, in Brooklyn. It's very expensive. It's a cap rate that we just don't have the investors to go out and do. So I have to go do that. It's a requirement. So we never buy a property that we don't tour. So maybe that's not a negative for some. For me, you got to get real comfortable in a market and understand the market. We offer on deals that we don't tour. But then once we get close, we get on a plane, and it's 2-3 days away. I just had a little baby girl 3 months ago. So the last thing I want to do is go to work and go tour the buildings, right? I want to stay home. So that's a negative for me.
So, Chris, your question was, you were specifically mid-sized deals, right? You want pros and
large
cons.
as well.
It's large as well. Right?
Yeah.
Well, John
Sorry,
has 3,000 units. It's everything.
No, I guess I'll cover quickly the mid-size and larger size, touch on both. I think the mid-size, like the 50, 60 range, the challenges is if it's not lining up for Fannie or Freddie debt, small balance debt, you're likely going to be in a recourse space. So you're borrowing, and at the end of the day, if something goes terribly wrong, you're personally responsible for it. Versus if it's a non-recourse loan and you were honest and everything was by the book, you give back the keys and that's basically it. So there's a comfort, and I've signed on multiple recourse loans, and I feel like if we're going to raise money for a deal, you should be willing to sign on a recourse loan at the end of the day. So I think that's the one challenge that would stand out to me in that deal size, and just the debt options in general. $5 million plus, you're going to get a much larger array of debt options for wherever the deal is, regardless of how stable it is. That's my
And recourse and non-recourse. Recourse debt, if you mess up, you're liable for it. So they're going to come after you personally. Non-recourse, you can mess it up as long as you didn't steal and you did everything by the books and the deal just didn't work. You give the keys back and you don't have to worry. As Josh said, the sub $5 million space, it's tougher. There's a lot less options for non-recourse. A sub $1 million space, really. Then you're basically exclusively recourse. That is a very rational. I was going on a different tangent, but that alone, the debt side of it, you get very good debt, $5 million or plus. You get a very attractive rate. You can get 12-year fixed. You can get 30-year fixed. So it's significantly, the debt side as you get bigger is significantly better.
So on the midsize for me, it was my stomping ground, if you will, to get my confidence level to go big. I had done like 12-unit, 8-unit, 5-unit single-family homes, syndicated a 60-unit, got it cash flowing, did huge, like big rehabs, like new roofs, everything, and I felt like I knew what I was doing. After about six months to a year, I was like, okay, I'm ready for the big time. So for me, it just gave me my confidence level to go to 100 plus.
Okay. And I think for me, the largest thing you see as you continue to go up is, one, I think the pro is obviously the on-site staff. We kind of talked about it already. Once you can support that, you get lower management fee and you get dedicated people there, which is huge. But then just your economies of scale and everything else, which I know we've kind of touched on, but it's true going from 70 to 100, 100 to 200, 200 to 500. One of the bigger examples is if you have 10 HVACs that go out, if you bring out an HVAC guy, you might get a 10% discount, where if you only had one, you're going to pay more per unit. So the larger you scale up, the more things you can do at the same time, your percent per unit is going to go down. So maybe the dollar amount total is larger, but a lot of that stuff is going to go down to the point where, we just closed 550 units in Jacksonville. We've had serious discussions about getting all our materials from China and overseas and Asia because the discount is 20, 30, 40%. It's still a little bit
long.
Not for long.
It was
not
20, 30,
It was at the time. Yeah,
it's
so
now a premium.
Well, it still will be. It's just going to be 30% higher here. So, so that's an extreme example. When you get really high, that's why you see $2 billion hedge funds. They've got stuff coming over all the time. So on a smaller scale, though, right? If you go from 2 to 4 units or 2 to 10 units, right? If you've got 2 units now, maybe you can negotiate a slightly better price, or you get a slightly lower management fee. If you go from 50 to 100, you can have slightly less per unit on payroll, but the same sort of staff. The same thing from 100 to 200. Now you got 4 people working there, so you got more eyes on the property. It's not too much harder to do 100 to 200. It's just a little bit more work. You couldn't do it with 2 people. So that's the biggest difference I see, which is a pro as you kind of scale up.
Yeah, and Sam said we were looking at a deal in Jacksonville that just had all new appliances put in. They're all new black appliances, and there's a market for stainless steel. We have 750 units in Jacksonville that we're doing black appliances in. So that's a deal that we can buy, take the new appliances out of an apartment, put it into the other apartment, save money there, and put the stainless steel. So we'll get stainless steel for the price of black, and you get that deal to be like, that's something that we can do because we own in that market. So that's very beneficial to us, and it's on the positive for bigger deals. You could take they just did it, and now they're Other groups have that benefit too, but you're not going to take appliances from Jacksonville and ship them to Columbus, right? It's going to be expensive. We can just shuffle them down the block and take those appliances and get a very good savings because it's a 159 unit property and we own 700 units that are getting black appliances now. So that's another pro that if you have economies of scale in one market, so maybe you could do that on duplexes and fourplex, 20 units. If you own in one area, you can do that, where maybe one of your properties in a much nicer area and it just had new appliances. You can move it and maybe you can get a premium on the other. So that's another thing that works on the big side and the small side, but obviously you have to understand your market and know what's going on.
The other thing too, I think, as you start scaling up is amenities as well, right? A pool costs what a pool costs. Obviously you get a slightly bigger one, it costs slightly more. But if a pool costs $100,000, it costs you a lot less per unit for a 50 unit than it does a 100 unit. Tenants love their amenities. They love pools, fitness centers, all that stuff. So the more units you have at a property, the cheaper it is for the total number of units to put that in, so you can attract better tenants, better paying tenants, charge more, whatever it may be. So when you kind of scale up as well, you can kind of do that stuff. You're not putting a pool in an 8-unit property unless the rent is $2,500 a month or something like that, So the amenity space is another thing that as you scale up, you start to see more of. One, because there's more people, but two, the cost gets spread out more across more units.
Another thing that's great. Great amenities, no one uses them.
Yeah.
So, costs you cheaper to put them in, and you could raise your rents.
I think maybe the last thing we'll touch on, then we'll open up to Q&A, is I think a question we would probably get anyway is people that are starting out that are newer, maybe have a little bit of experience, maybe no experience, and I think Chris, you talked on it, getting that confidence to go up. How valuable is it to start small? Should you start small? Can you jump in larger? Assuming you have the capital, the debt, all that stuff in place, just from a theoretical knowledge standpoint. Answer it how you will. How do you see that playing out for somebody moving into it?
I think it depends on, are you going to be an operator, an active investor, or a passive investor? If you're going to be an active investor or operator, if you have never owned real estate, I would not jump into a 100 unit right away. I think you should jump into a 20 or 30, get your feet wet, and then figure it out. And then maybe you can go bigger, but I would get your feet wet as an operator first to figure out this whole multifamily thing and reports and managing the manager and dealing with contractors and dealing with budget overrun and things like that. I don't know if I would do that as an operator going right into 100. I don't think I would have been ready for it. As a passive investor, though, I do think that you can roll right in, whether it be a limited partner, just passive investing, or as a passive general partner that gets kind of nuanced, but balance sheet partner. There are things like that I think you can go big right away.
Josh?
So, yeah, I agree with Chris's answer, which is somewhat self-serving to all of us, saying, come invest with us. We'll teach you what you need to know. But I think more important than that, right now it's very competitive, real estate in general. I think that's not a reach. Prices are definitely more here than they are here. So I think the most important part, if you're just getting started, is continue to focus on location. Just understand the location. I think in a downturn, the areas that get hit the hardest are the rougher areas, and the ones that bounce back the quickest are the ones that are in good school districts and have good retail shopping and things like that around. And that would be my advice, regardless of the size. Some people just can't get over the fact that it's not their deal and they don't have control, and I get that. So if you're going to do that and you're just starting, I think buy in a good area that give up 2% a year to be in the better part of that town or that market.
So just to clarify, if you're an active person, you're saying location being all things the same, you don't think there's a huge difference between a 20 unit and a 100 unit. You think you could probably do both, assuming you have the equity, the debt, stuff like that in place?
I think if it's your first deal, to start raising money is a bit of a leap. I think that anyone sitting across from someone taking out the complexity of securing the money, just from a purely able to do it. Let's say you it's all your money, right?
Yep.
Whether it's a 20 unit or a 100 unit, and you're active, and let's say you even own a couple single family homes or a duplex and stuff. You have a little bit of knowledge.
Oh, that's
Do you,
different.
yeah.
It's a knowledge.
Well, no.
It's tough. I think to me, it's completely knowledge driven. That if you do feel comfortable, frankly, just from an underwriting perspective, I mean, it's very, very difficult to make little tweaks to a deal to make a bad one a good one. So if you're not in this business, and each of us here have been in real estate in some way, shape, or form for at least 10 years, we've seen it and can feel those changes probably better than many entry-level investors can.
Mm-hmm.
So I think, I think if you're comfortable and you have that knowledge base, I have no issue with it at all. If someone, I went to school for real estate and, master's degree in real estate and all these things, and I have no issue with them starting larger, where they're probably able to jump in at that level. But otherwise, I would probably say start at a more digestible deal size.
The only thing that I would say different from that, my personality is a little bit different, but
True, different personalities here.
there is nothing wrong with going right out of the box 250 units or more. What I would say is if you go on LoopNet tomorrow and buy that deal, you overpaid. But if you
100%.
take 6 months to educate yourself, surround yourself, come to groups like this, and practice, and you feel confident enough, then anyone in here can go buy a 250 unit on their own. You got to look in the mirror and make that decision yourself. But do I think that you should start smaller and work your way up? Yeah, I mean, why not, right? Or invest with someone like Chris said, be a co-GP or something, work that way. But you can definitely buy a big deal right out of the box. But realize that if you offer on that deal and it's your first offer and you want it, there's 100 people that passed on that. So you got to think about it. So don't go online tomorrow and buy a deal. Right? Offer today and practice today for a deal you may come across a year from now. And starting smaller, starting bigger, it doesn't mean you have to buy it tomorrow, right? If it takes you 12 months to buy your first deal, you can buy a big deal for sure. It's just your level of confidence. Can you go to bed at night knowing that whether you raised money, whether you bought it in another state, if you can go to bed at night knowing you're doing everything that you're possibly able to do and make it work, you're doing the right thing. But that's a personal decision. I don't think there's a wrong way or right way, but I agree with Josh 100% on the location. Don't go buy a class, D property in, just because it was cheap and it's a 300 unit deal and you think it's going to work. That I would never recommend. But if you have the ability and you could go buy a solid deal and it's a bigger deal, whether it's 50, 80, 300, you can definitely do it out of the box as your first deal for sure. Just make sure you're educated and and you could surround yourself with people that can help you if something goes a little sideways.
I just feel like I feel like I wasn't ready for it.
Exactly.
So that's like I knew myself. Like I was like do I think maybe I could have learned in the 100 unit? Yeah. But I felt super confident going into my 174 unit after being in the 50 unit. And that's how I raised $5 million. Would I have been able to raise $5 million by being like, yo, this is my first 174. I got this.
It would have been harder.
I do think we definitely disagree on that one a little bit. I do think there's real barriers to entry just on the debt side, that it's not just net worth and liquidity. They are looking for experience. I mean, you've done this also. I mean, I've done deals where from a net worth and liquidity perspective, I personally would have never qualified for that. But at the same time, the people that were guarantors on the loan with me, they wouldn't have had the experience to be able to do it. So, there is, look, if you're ultra high net worth, you could probably get any loan anywhere. But I think there's definitely some truth to that where you may need the right partnership to be able to step up in deal size.
We have a lender, a CBRE lender who's fantastic. He does a lot of our small balance loans, and he told us, the stories he was telling us. We went out to dinner, and he was saying there are people that call him that, have a ton of money in the bank, and they don't know what a financial statement is, and they're like, he can get them loans, which is scary. It's a little, but they can get it done, and he recommends. I think you want to talk to someone else because these people are completely clueless, and they have what's a cap rate, right? Those are questions that people are asking a lender as they're going to get a loan. Like, that's scary. I don't think that guy should go buy or that woman should go buy a 250 in a deal. But if you know what you're doing, that hurdle can be overcome to a degree. You might have to bring in a partner. Yeah. But you can do it, and like I said, I'm taking the other side of the coin. I could easily argue the other way, but that's no fun.
I think a large part of it is comfort. I think part of it, though, is getting over that comfort. If you have a Class B, A deal, 50 to 500 units, you're basically doing the same thing day to day. It's just the numbers are slightly different. You got to take in a little bit more information. You got to do a little bit more legwork up front, but you're doing the same processes just a little bit more. And your management team is going to be doing a lot of the grunt work anyway. You're just kind of overseeing the stuff. But I think to play the other side, you've got to be comfortable with what you're doing, which I think was what Chris was talking about a lot, right? If you're not comfort, if you know yourself and you're not comfortable going out to buy a 100 unit, whether it's your own money, other people's money, the debt side, whatever, definitely start smaller, because if you're not comfortable, you're going to make mistakes, or you're going to doubt yourself and just hurt yourself in the long run, whether it's taking too long to buy a deal or passing on one you could have taken down if it was a 50 unit or a 20 unit. So your comfort level is a huge thing, because you can't be doubting yourself while you're putting in offers and talking to brokers. Confidence is a big thing in winning deals. So, it's a little bit of a balancing act, but from the pure deal side of it, there's not a whole lot of a difference from, a 70 unit plus and up, 70 to 700 units. It's not a whole big difference.
Yeah, I mean, it's a personality thing. Like, I respect
Exactly.
John, like that you went out and like really early on we're like looking at 300 units, and I was like, whoa, dude, this guy's freaking awesome. And it took me, like, I just looked at a 344 unit, but I don't think I would have been able to look at that and have the confidence of how to take it down without then getting to the 174. That's what I needed. It was my journey. Yeah. And that's what I think you have to be self-aware. What's your journey?
100%.
All right. Anything else, guys, before we open it up? All right. Awesome. Questions? Yeah.
So I guess all the deals that you guys are making, are those like, already established buildings, or those new developments? Are you guys dealing with new developments, or how does one differ from the other?
So are you guys doing existing buildings, new development, and how do they differ from one another?
So we've built ground up. We built a ground up student housing deal. I mean, this is the definition of what not to do. We did it. I had a buddy who called me and said, I need someone to help sign a loan. I have everything in place. It's non-recourse. So I looked at my partner. I said, hey, you want to sign a loan and get 10% of a deal? He's like, yeah, sure. Why not? What do we have to lose? It's non-recourse. That turned into, I only need $500,000, and you just got to sign the loan. Into us raising $2 million. We already had an architect. Plans were done. We stepped into it because it was a really good story, and it's going to turn out to be a really good deal. But we built that ground up. That's a ground up student housing deal from here to the back wall. That's the front of the college. We're the first property you get to. So little different. We built ground up. We've also bought completely down to the studs vacant buildings and completely renovated. And we just bought a deal in Columbus, Ohio, 100% vacant. And we toured it. We walked it. There was heroin needles all over the floor. People in there. Like, I walked through it. I said, someone's going to jump out here and potentially hurt me. But we've done that. We've also bought existing buildings and fixed them up. And we've also bought, completely stable deals. One of the best deals we did, it was a 200-unit property. We didn't do a thing. It was 200 units. We put in about $130,000 over 2.5 years. And we, the deal doubled in value, but by just sort of buying a really clean deal in a great market. So we've done all three. They definitely differ. I don't recommend development for anyone that has no idea what they're doing, because there's so many things. Like, we did it, and the guys, there's an impact fee. Like, what the hell is an impact fee, right? And it's $30,000. Whoops! Like, didn't have that in the budget. It happens. We've learned now. We just put a deal under contract that we could develop. It's got enough land that we could probably build 180 to 200 units. It's 64 there right now. So we've looked at it as a potential development, but we've done it before. And we also, my partner is 55 plus. He's worked at Cushman & Wakefield for 30 years, and he's built shopping malls. He's built single-family houses. He had a little bit more experience. If you're fresh and you've never done anything, I talk about like going to build. Don't build a 300-unit as your first deal with no experience. That I probably wouldn't recommend that.
Yeah, I mean, my partner's background's also, it's on the development side. His first deal he did before we came together was a ground-up development. But I mean, that's what he did professionally. Right now we have one deal that it's a retail deal that does have a development component, but we don't look at anything that would just be land to build. It's just the timelines make me nervous more than anything. That we wouldn't be buying it all cash and not have debt to carry before we're able to say go. So it's just our approach.
Yeah, on the development side, you're not going to buy it in cash flow tomorrow. It's going to take you 12 months best case scenario, probably closer to 18 or plus, depending on the market. We built the student housing in 12 months, but it's Clarksville, Tennessee. It's totally different. So you gotta understand that. I agree with Josh. I'm not a big fan of betting on 3 years down the road. That's not what we normally do. But we've done all three.
I've only done existing. I mean, I've taken some single-family homes that were vacant, but mainly stabilized properties where you're going to do a big rent push or like there's going to be a large amount of evictions. But I feel like I'm ready for a half-vacant building. I would do a 200 unit, 100 units that are vacant at this point. I don't know if I'm ready for ground up. I don't think I'm there yet.
I think we could probably spend an hour and a half answering your question. So just high level, their development is a totally different ballgame, especially in that space. It's, we get emails for land and we just delete them because it's totally different place to look at it, totally different investor set, totally different debt. So there's a lot of different stuff. So most of the stuff we're buying is existing, even if the inside is vacant and you got to come in and put appliances, but you're not putting in slab, you're not putting up foundation or framing or roofs or stuff like that. So it's just a little bit more similar to, buying a deal that is stable.
One thing I'd say, because I am sort of attracted to the land plays in good areas. Some of the most successful development companies, they're not buying and building right away. They're buying, taking their time. You could look at like Toll Brothers. They own endless land where they're being very selective about when to develop it where. So I don't know.
With a 3-year forecast.
I mean, they're decades old, and their land base is just so low that they could build basically with minimal risk at all.
Yeah.
So, I mean, I don't think any of us have that type of time frame at this point, but I love the idea of sort of buying a piece of land in a great location that I like, if there's some sort of a story to get compelling value, and holding it onto it for a very long time.
One thing that we just started doing, probably at the end of 2017, we've done a pretty large push into the mobile home space for that exact reason. You can cash flow while you wait if you like the piece of dirt, because there's people paying rent. So if it's a great location, yes, there's a mobile home park on it. I get that, but they're dwindling. The supply goes down every year because they're being developed. So people are buying them as covered land plays, you could call it that, or in the future. So it's an alternative that we've looked at. It also complements a lot of our multifamily stuff from a cash flow side. So it's a little different than what Josh was talking about. It's a really interesting space, right? Development, it's the sexy, beautiful. It's awesome, right? I want to own that building. Buildings that we own, you guys, I'm embarrassed sometimes driving through them. They're rougher properties. They're not that brand new Class A development. But it's intriguing, but it's something that we could. There's an alternative way around it.
Who else?
Any other questions?
What do you do on the exit strategy? Your properties. Talking about a lot of buy, but your exits.
Question was, what do you guys do on exit strategy? Talked a lot of buys, but what do you guys look at when you're exiting properties?
Go ahead, Josh. You were about to say.
I was going to give the it depends answer. For us, it's driven by the equity, who's in the deal. If we do have a small group of equity, we'll often let them dictate the sale at the end of the day. We have a deal that there's no target sale date. We're refinancing long-term debt. We might hold on to it for 15, 20 years at the end of the day. More commonly, we're setting the expectation of 5 to 7 years. It seems to be a comfortable range of time where people are willing to invest, sort of know that it's illiquid, but they're relatively okay with not having that cash available, because it is, at the end of the day, an illiquid investment. So the exit, would, I'd say, almost always be a sale. Whether or not there's a refinance beforehand would depend on the deal.
Yeah, we've gone in early on. We were, as quick as possible, get out. And now the market, who knows where we are? We're probably closer to the top than the bottom. So we are definitely in, telling people 5 to 7. We haven't held the deal longer than 3 years so far. It's been buy, do what we got to do, and opportunistically sell. Right. We're selling a deal right now in Mississippi. We bought March of last year. We had a 3-year hold, 3-year loan. Their money went hard, so they're supposed to close in 30 to 60 days now. They hit the number that we needed today. So we got an offer. It was opportunistic. It's a really good deal for the investors. So we took it. But for the most part now we're going into deals with 7-year debt, a little bit longer term horizon, just because you never know. So that's sort of the education of our own investors. That's where we're pushing them. It's going to be a little bit longer than what it used to be.
Yeah, we have deals that were made to be 7-year holds, and we're going to be exiting at 3 years. Get a silly offer price, got to take it. And we have a deal that it's meant to be a 10-year hold. But 3 years from now, if somebody wants to do a loan assumption and it's that silly price again, I can't say we were not going to sell. So it's depend. Where are we at the market? What kind of return are you going to get for the investors?
Yep. And you also got to look at it. A lot of our investors will go into another deal with us. So, whether they 1031 or they go on their own way, you also got to weigh it out as, okay, what are we going to do if we sell this? If there's not as good of opportunity, maybe it makes sense to hold it. But for the most part, our business plan going in is 3 to 5 years. It used to be. We've switched that to a longer term outlook.
I think also to clarify too, 2 points for us, because we're raising money from investors. People don't want to invest their money indefinitely. So most of the deals don't have we're going to cash flow this for 10, 15 years. Most people don't want to give up control and not know when they're going to get their money back, or a rough assumption of when they're going to get it. So we usually have most of the time sale, sometimes a refinance in a set amount of years. Anywhere from that 3 to 7 year time frame is pretty typical. The other thing too is, from our side as a business standpoint, the business model for us is profit sharing upon sale is the bulk of income for our businesses. So it's beneficial for us to have a sale exit plan rather than a refinance or hold indefinitely, because we are raising anywhere from 50 to 90% of the equity from other investors. So there's an interest for the investors and for us to have either a sale or refinance exit that isn't super long in the future. So it just works well for both parties in that regard.
Do you need to, when you're looking for money, do you need to create a red herring, or can you just do it with a basic business plan? Or it's based upon the volume of so it's based on SEC?
Yeah, based on SEC regulations, depend on how much money you raise, also who your investors are, right? If we've never met you, we vet our investors just like we expect our investors to vet us. We want to know, who they are. Can they support it? Is this their last dollar in the bank, so on and so forth? But it's regular SEC stuff that, I would say every deal that we do that we've done recently has all been 506C, whole 9 yards.
I have one other question. You seem to carry more aggressivity than the other 3 guys.
It's personality.
I'm not attacking you.
No, 100%.
If you're that confident, I wish I was. With that said, is it because you come from a construction background, or you understand?
Yeah, no, I would say.
Let me ask first before you stop cutting in.
Mm-hmm.
The question was, you seem more aggressive than the other two. Is
3.
that the other 3? Is it something in your background? Do you come from construction? Why is that, or is he wrong?
No, I got nothing up here. No,
just empty space.
Yeah, no, it's that's part of the reason why. No, I would say that I don't actually have a construction background. Like, I just got to my house, I had no idea what I was doing. Right, I had a buddy that helped me out very much, but no, I had I don't want to say more real estate experience, but I started buying property at 20 years old. Properties in Philadelphia that were tax deed properties I was buying for $400, $1,000, knocking on doors, where there was a good shot, someone could come out with a gun, or there was no floor, there was no roof, like you couldn't go into them. So I saw what the worst case scenario could be. So I looked at it a little bit differently, and then I progressed up. And the first property I bought was a very rough, 30% occupied disaster. And I realized, okay, it's going to cost X dollars to do a floor. It's going to cost X dollars to do appliances. So I put it together, and I used that and learned over time. So I'm significantly better at not making mistakes today than I was when I started. So I would say that I also surrounded myself with some good people, I like to think. I say that all the time. Real estate works. Anyone can do it, but you got to have a database of people to call if you have a problem. So if you can make a call and get something fixed, it's a lot less scary than if you have no idea what you're doing.
Just to add on to the exit strategy question, are you guys taking into account who your end buyer optimizing NOI to its full potential? Are you going to leave something on the plate for the next guy?
It's a great question.
So, yeah, the question was, when you guys are exiting, are you guys leaving meat on the bones? Do you guys try to fully optimize the NOI? How does that play in with your exit strategy?
Yeah, I mean, I think definitely. And then I'll add a specific piece is, so we're holding something for 10 years right now, the 174 unit. And the galvanized pipes need to be replaced to PVC. So we're replacing them to PVC, not just for the NOI piece, but because we also know that in 10 years, we're going to be able to serve up a product, 1972 built, to the next buyer that's going to be wondering, how old are the roofs and how old are these pipes underground? So that is definitely part of the strategy of what is the next buyer going to ask 10 years from now or 2 years from now or 4 years from now.
Yeah, I mean, I think the question about leaving meat on the bone, like, are you going to upgrade 70% of the units to leave the next 30 for the next guy, or just prove it with 20% to leave 80% for the next guy? I could give another it depends answer. But what I would really say is I do, which might be contrary to what you guys might think. I'm not a big believer in the, don't leaving meat on the bone. I think if you can drive NOI, especially in this environment where value add is just so attractive, to be able to sell a fully renovated optimizing deal at a pretty high cap rate, I mean at a relatively high cap rate in relation to value add deals, I think it's very, very compelling. And I know there's deals that have been fully renovated that do sell at a premium as your true turnkey product. I think if you asked me that 3 years ago, the answer would be different. But I just know that gap from value add to, more class A or turnkey is just that much tighter now. So that's my take.
Yeah, I think that makes a good point. We just were down in Jacksonville. We toured about 15 different properties. One of them was a 100% renovated property. That's the deal that we looked at and said, we could take the black appliances and move them over to our property. But even that deal, which under the broker's own admission is 100% done, there's nothing to do, they're selling a value add story. So I think Josh is right. There is something to say for that. Our business strategy is different. We're buying, we have 700 units in Jacksonville. We'd like to get to about 2,000, and leaving some meat on the bone, whether it's 20%, 80%, we're renovating about 50% of the units, but our plan is to sell that as a portfolio, maybe to a significantly larger company. So we're looking at it from that standpoint. Our Mississippi deal, the plan was to fix the deferred maintenance. We got through half of it, or 90% of the renovation. We didn't even touch the interiors. We did plan to do 250 of the units, which is 50% of the property. A guy came knocking on our door way before we can get there. So we went in with that intention, but Josh is 100% right. There's a broker will sell a story, and there's a lot of guys out there that'll buy anything right now. So we go in with a plan, but it's not set in stone. The first property that I bought, we sold for just under $2 million. It's on the market right now at 3.5 with under contract. And there are two people here that invested in that deal and both of them saw it. They would never, nobody would pay $3.5 million. And it's only 2.5 years later or 3 years later that it is under contract. And you can't guess. You can go in with a plan, and we normally do, but sometimes it deviates a little bit.
So I think I'm going to kind of contradict Josh a little bit, because when we were touring the deal that was completely done, they have no buyers because their cap rate is so low. Where I think he's right is if you can increase NOI enough, let's say you bought at a 5 cap for argument's sake, you got to be able to get a profit at a 6.5, 7 cap on sale, because nobody's buying a 6 cap stable deal today, especially in the 70s and 80s vintage stuff. So if you can buy something and push NOI, double it and sell it for a 7 cap, then yes, I think you'll have buyers there, because it's not Class A stuff where you're going to get institutional money. But I think because value add is such the hot thing right now, and that's what everybody wants, you have to leave some sort of meat on the bones, whether it's real or fake. Every deal you get is value add. I mean, we get ones that are 90% renovated, but they say, you can now do a premium upgrade, and they haven't done
LED lights, and you can get $50 more.
So
put in smart locks and get extra $20. No, you can't.
It's just, I mean, we haven't seen a marketed stable deal. I don't even know if I've seen one since I've started working. This is the first one, and we went there, and the broker, he almost looked depressed. He was like, he's like, we don't really have buyers for this.
He admitted it. And so I think to Chris's point and Josh's point, I think the market dictates that strategy for sure. Because he walked through the property almost knowing that he's like, we're shooting for, 100 a door. We're not going to get there. They told us right out of the box because he's shooting for a price that's extremely aggressive for that specific fully stabilized deal. But we just did that as well. We sold 160 unit, the exact same size property. We went out at 100 a door at 16 million. We accepted 14.5 because we knew that we weren't going to get that. But and that's not unsimilar to this deal. It's, I would say, significantly better renovated, but there was nothing left to do at our property. It was 100% renovated units, clubhouse, amenities, whole 9 yards, and they went out at a crazy price, and the market dictated what it was worth. So if there's a real seller, he'll sell it at what the price dictates. But I think market dictates that because it's, where that deal's physically located, you're going to have to buy into the future to get to the price he wants. And we're never going to do that. But what Josh was talking about is I think that, I think that people will get a crazy aggressive price if it's stable.
What was the cap rate on like the $14.5 million sale?
Our sale, what was that on Bradley?
I don't even know because it was loan assumption. Was it a loan assumption?
It was a loan assumption, so a little skewed. But even still, it was also trending. We owned it for 2 years. So the second year, really the last 6 months, it was stable. For the first year and a half, we had to evict some people and get some people out. But I would say it was at true 12-month financials. It was probably somewhere in the 5. If you take the T6, it was somewhere close to 6%.
Okay. Which, if you ask me, that's I don't think any of us are modeling out an exit for 70s, 80s products sub 6 cap. So if you're doing that on a true NOI for an optimized product, I see no issues with that. That said, I know that deal. I don't know that there was no value added, but fair enough.
There was plenty left to do. No, but it's a great question. So I think that it really depends. I think the market dictates a lot of it. So, if we continue going in this bull run that we've gone on for 10 years, I think that a fully optimized property is bullshit, right? What's a fully optimized property? Someone will come in and put a backsplash and get one tenant to pay for it, and then they'll try and sell it at a lower cap rate. So, and brokers will always sell value add. But right before this, I was on the phone with a very good friend of mine. He sold my first property. He was a Marcus & Millichap broker like myself. He's on the buy side now. I said, I got to ask you, when you put your pro formas together, you own deals now. You can't run deals for what you guys pitch. And he's like, you're 100% right. It won't work. So the brokers are always going to be there. Their job is to sell the deal. So they're going to do whatever they can to present that. So you could leave meat on the bones. At the same time, we sold another deal that I thought was maxed out. We never get a nickel. The guy's coming in, putting in a pool, blowing out the units, and he's doing a fantastic job. He emailed me today. He's like, wow, I'm so happy you sold us this deal. I was like, what? I thought it was at the top of the market. So I think there's always room. It's just a matter of, what the market's going to dictate.
How do you guys structure your deals typically? Like, do you guys pay out a preferred return? Are you guys just doing like straight splits, or how do you guys do that?
So the question was, how do you guys structure it? Preferred returns, splits, different stuff like that.
We do both. We had one deal where we didn't have a preferred return, but on the most recent one, we have splits and 8% preferred return.
Yeah, we're falling into a box now where there is some sort of a preferred return. After that, it may be 80-20 or 70-30, and then a hurdle based on performance at 14 or 15.
Similar. Same thing. The only thing I say, the deals that we don't have a preferred on, we bought a deal in an opportunity zone. And from a sponsor standpoint, now we invest at least 30%. Every deal's been at least 30% of our own equity, either myself or my partner. So it's a little different. But on that deal, we didn't do a pref because they had to incentivize us to operate that deal for the next 10 years to take advantage of it. So, but for the most part, we do an 8% preferred with some hurdle to 12 to 15 with a hurdle over that.
And just to clarify for anybody who doesn't understand what that is, we obviously have investors and we have different agreements with them. So preferred return is basically we don't take part in any of the profit sharing until an investor gets an 8% per year. And then every dollar over that gets split in favor usually of the investor. So 70-30 would mean the next dollar goes 70 cents to the investor, 30 cents to us. So that's where I mentioned earlier, we make the bulk of our money profit sharing. That's how that works. So we don't really make anything if there's a preferred return, except for a couple small fees for operating the deal, until we hit those certain hurdles. So that's how deals are structured, and there may be one hurdle, there may be two hurdles, there may be no preferred return. So there's a couple different ways to do it, but I would say unanimously across the board, everyone's pretty in and around an 8% preferred return with an 80-20% split or 70-30% split. And then sometimes you may also see a second hurdle at 12%, where if it was 80-20, it may go down to 70-30. So the better we do, on our side for operating the property, the more percentage share we get, the better we do. So just for anybody who didn't understand what that was.
In ours, we have actually one of our waterfalls is if it's over an annualized 20%. So if an investor makes 20% annualized for 5 years, over that, it's 50-50. I don't think investors are going to complain that much if they're making 5 years 20%.
No, sign me up.
I'll take it.
So you said you started kind of in Philadelphia.
Mm-hmm.
So did you buy houses, let's say, across the street to kind of make your profit better in the first house?
So the question was specifically for John, started in Philly. Did you buy houses across the street from each other to kind of, I guess, manufacture having multiple units even though they're across the street, right? Yeah.
Yeah, no, I
To try
tried.
to make it bigger.
So I bought a lot of properties at auction. So you had to buy what was on the auction. But after I bought a property, I would go there to assess it and see what happened. And then I would knock on neighbors' doors. It's a very friendly community. So you go there, you knock on a door, and everyone starts to you, what are you doing? That property's vacant, So then I would try and make some offers. Or if I looked online to see maybe there was 4 houses on that block owned by an investor, I would call them, hey, you want to buy this one and add a 5th one. So yes, I would try and buy it. Also try to sell to people that own multiple properties on that block. So, but yes, I did try and buy them close together so I could operate them as one.
So I'm going to pitch it to you, Chris, because you had 40 in Syracuse.
Yeah, totally.
Very similar. How did it go for you?
Yeah, I was looking for ones on the same block. Efficiencies of the management company going there and making repairs, and also with the intent on the sale to sell as a portfolio.
Correct.
So you see Detroit now. Is that a place when you see like whole blocks of vacant homes? Would you tell someone to operate in something like that again, or is that just a loss?
So if he's asking if you guys see Detroit, whole rows of vacant buildings, stuff like that, is that something you would go into to try to pick up scale in an area where maybe you could pick up multiple at the same time?
I don't know Detroit well enough I haven't researched it enough to say I want to go there or not.
So it's intriguing, but I think Josh will give you the answer that it's intriguing. It is. Could it work? Yes, but it hasn't worked for quite some time. So it's a little scary. I would prefer probably not to be there, just for the fact that there's so much of that. But once again, if you're a young guy or a young girl and you want to get up and move out there and do it,
yeah,
it could work. I mean,
but you got to be there.
You got to be there. You can't expect it's going to work without you. So I would say, not for us, but if you can put the business plan together and you get real comfortable with it, maybe not Detroit, maybe somewhere else, but it's intriguing. We've looked at it a couple times and we just can't, pull the trigger, and I don't think we will.
Yeah.
So Josh, I'm going to let you finish just to touch on that. I think ideas are shit. Execution is key, right? So could be a great idea. Unless you can go out and do it and execute, it doesn't really matter, right? Everybody's looking at Detroit. They're all thinking the same thing. So yes, the question you have to ask yourself, why hasn't somebody done it yet?
Yeah, I mean, I think John touched on the market piece. I mean, Detroit's lost so much population. And I know now there's a good story upswing. I think it was just hit really, really hard. So you could maybe make the argument that it's closer to here than here, like some other cities. But I mean, there's areas just based on how much old housing stock there is and the lack of population that I don't know what they're going to do with those areas. So, I don't know that one investor of any of our size or even collectively can change that. But that said, I think there could be some opportunity in Detroit.
I mean, we invest in old homes in Syracuse, and the cost of repairs is going up. So you'd have to consider that on older housing stock.
I think you had a question, right?
If you're coming from a non-finance background, do you guys have any tips on how to properly underwrite deals?
So
Sources on online, where to find them?
So that'd be all of us, right?
yeah. So question was, if you don't really have a finance background, or let's say even a real estate background, what are some good ways to get your feet wet underwriting, some good resources, or ways to different practice or find out more?
I mean, all of us actually got educated. We had a mentorship program that was pretty intense that taught us how to underwrite There are some underwriting software out there. Who has a decent one? Michael Blanc.
Yeah.
You know, there's some underwriting Excel spreadsheet templates that you can, but they're not really going to teach you how to underwrite. That's going to be shadowing somebody or taking some sort of coaching situation.
Yeah, I don't know the right answer, but I think finding people that are doing it at a level above you where you could provide some sort of complementary value, whatever it may be, I think that's your best way in and to learn. I think, Chris, you could speak to it as a part of Toro that, you know, you were able to add really good value to John and Don that were already doing it at a much higher level.
Yeah.
So that'd be my advice.
I was gonna say, if you want the timely answer, practice where you go online, and it could be a deal in Brooklyn, it could be a deal here, underwrite it, offer on it, and track it. See what it's sold for. Then try and find the buyer or the seller and see, hey, how do you look at it? That's the long drawn out process, right? You have to watch the market and pretend, and then you can get a better idea. Whether you're doing it right or wrong, you won't know until 3, 4, 5, 6 years from now. But if you offered, 1.9 and it sold for 2.6, maybe you're conservative and you would have bought it better. But if you offered 1.9, it sold for 1.2, maybe you know something that someone doesn't. So it's not necessarily going to teach you the right or wrong way to do it, but you can practice. And that's what I would do, whether you know you're doing it or not. Also, brokers, as much as I said they said that they're wrong, if you like a market and you get to meet managers and brokers in a market, you can speak to them, how do your deals normally run and why, right? Just ask the question why 7 times in a row and they'll give you answers. So those are great ways and they work, but it's only going to be as good as the foundation you build. So you can go pay a mentor, whatever whatever. But if you don't take the information, if I give you all the tools in the world and you don't use them, whose fault is it? So, but you want to practice on your own too. You want to just get through it. There's a ton of books. Bigger Pockets is a great website. Accountants, talk to them how they, when they do the accounting on deals, how they typically expense stuff. So there's other ways, but you got to do a little of it all and see which one works best for you. But Josh is right. Chris can speak to it. Add value to someone. Do something that no one wants to do.
Yeah, I mean, one more just small comment to that. I think, all right, I know the math behind real estate investing. It doesn't get that complicated.
Mm-hmm.
It's not like high
calculus.
No. But that said, there's a lot of nuances to it. So I think it goes back to something you said earlier about just the people side of the business, that being able to put together a team that's proven where you're vetting more the people than the property, that they're going to be the ones that can guide you with any acquisition. Like especially on the smaller side, a good property manager is worth everything because you're going to learn from them. You're going to provide some level of safety. So I think it comes back around to that. Just at the end of the day.
When you get used to underwriting too, you can actually go to your property managers too, and then start dialing in the pieces that need the
tweaking.
The tweaking.
Mm-hmm. And we all still do that. Every deal that we do, we're not just relying on ourselves.
Oh, trust me, we're trying to tweak.
Right.
Like we're trying to make it. Like, how can we get this there?
Yeah.
What are we missing?
Yeah.
And as referrals, like if you love Jacksonville, talk to us. I'll give you contractors, managers, brokers to talk to, and they will give you all the time in the world. That's their business. So utilize those tools. So if there's a market you love, ask one of us. We're in, from Indianapolis to Alabama to the coast. We're there, and we know people we could introduce you to.
So just because I think I'm a little bit different than the three of them, I think they all had some good points, right? An underwriting tool is only as good as you make use of it. So it's really getting the knowledge how to do it. Brokers, managers, stuff like that is key. But coming from a stockbroker world into this, I really didn't know anything. And being next to John and Don all day, I can say pretty confidently I wouldn't have gotten to where I was as quickly, being underneath them. So I took a job, but there's also, I took a pay cut to be there from my other job. So I paid for it to get the experience. So it's not easy. But I think a couple ways if you were convinced on doing it on your own is, one, there's so many free resources nowadays. There's tons of people making free videos and free webinars and free online blog posts. It's really starting to trend. As much as you see, buy my course and buy this, buy that, there's a large trend of people doing a lot more free resource stuff that I think you can find. And if you start talking to brokers and look at books, and maybe you have a relative that's involved, or you talk to manager, and you can start putting these little different pieces together, you're going to narrow that field where you're going to get significantly closer to the bullseye. And just as they were saying, right, as great as we think we are at underwriting, we never nail the expense for repairs and maintenance exactly on the dime. We get very, very close, and a lot of times line items will shift. One will be a little high, one will be a little bit low, and some stuff is easier than others, and we're always in the ballpark, but that's really only going to come with time, and it's something we do every time, right? If we look into a new market, you know, we're looking to get into Indianapolis, that market's going to be slightly different, you know, because what you pay an on-site manager in Indianapolis versus Los Angeles is two very different things. So, you know, we're always constantly learning, and, you know, there's a, you know, an uptick in knowledge that we have to gain as well. Now we have a higher base than somebody completely brand new, but we use those same resources to go out, and we rely a lot on people in the local areas, managers, brokers, on-sites, stuff like that, to get the knowledge and then compile it all together. A lot of what we do is taking knowledge from different places and being the person that puts it all together into one kind of package. So it's really just experience and leveraging other people to get all that knowledge into one place, and then over time it just gets tighter and tighter and tighter.
Are your investors like typically like financially savvy, or like for example cash on cash versus like internal rate of return? Like how do you guys go about that, or it just depends on the investor?
The whole gamut.
Yeah.
So hold on. Yeah, the question was, are your investors financially savvy? Do they understand the different terms? How intricate do they understand, you know, all the stuff that goes into it?
Yeah, the entire spectrum. Like we have some that don't understand it, where you have to educate them on it, which I think is great to educate people on those terms. And then you do have people that are in financed investing, and they're looking specifically on how you're getting to those numbers.
Yeah, we've gone the full gamut. We have mom and pop, friends and family, all the way up to family offices and institutional quality investors. When we started mom and pop, like most, then I made a big push to the other side, and I'm back the other side. It's just yeah, exactly. So, we go both ways: IRR driven, internal rate of return, and/or cash on cash.
I think an important distinction too is a lot of people may think that having an uneducated investor is beneficial because you may be able to get higher fees or stuff like that, but as soon as something doesn't go quite exactly to plan, it is 1,000 times worse. And having somebody that's educated and understands what's going on is just going to make the relationship stronger in the long term, right? First off, don't take advantage of people. Wrong thing to do. I don't think any of us do that. I can say that with pretty good confidence. Know everybody here pretty damn well. But it's having somebody educated is going to make the process easier, because if you know you drop from 95 to 90% and you have a valid reason or an invalid reason, it's going to be a very smoother conversation. And if people understand that, hey, there's steps to be taken, there's things we can do, and it's not the end of the world, it's going to go okay, right? Time heals a lot of wounds. If you've got the person that doesn't know anything, you gave them numbers and they think this is gospel, and all of a sudden instead of being at 93%, you're at 90 for 6 months, they're going to be up your ass, phone calls night and day, trying to figure out why what you promised them was going to happen isn't happening, or something in between. Or, you know, they thought a 15 IRR was they're getting 15% a year. If you can educate, like, that's a very simple one to educate. Some of them stuff is harder. If you can educate them up front, it's going to be a better relationship throughout the process and going forward. So I think having an educated investor is always better. And if you can spend the time to educate that person, one, they're going to, you know, have gratitude towards you, and it's just going to be better in the long term.
Yep, I think all that expectations and communication along the way at the end of the day, regardless of the level.
Yeah. Setting expectation and communicate. I think you had a question over here.
What do you guys think about tertiary markets where you don't have colleagues who've been there before? You're assessing a brand new market that's a little bit, I mean, not that you guys would do that, but if you were me and we were looking at, you know, a tertiary market, what would you look out for?
So question is, if you're looking at tertiary markets, maybe you don't have a lot of context there, if any at all. How do you go about that? What do you look for? What do you guys feel about tertiary markets? I'm also going to throw in there
questions, but it's under the same common theme that we're just driving accountability and growth with every question that we're asking, basically.
Exactly. Lance?
For you guys that have done refi with banks, like 50, 100 units, what's the process like? How many leases do they look at? How many units do they look at? If you give them the P&L for the year, are they just taking it with a grain of salt? Are they digging into it? Are they saying, you're making 100 grand, here's a cap rate, here's the value? When the appraiser comes with their value, can you go back to the bank and get it increased? What has your experience been like on refis that you guys have closed on?
So just because it's working and we didn't lose it, thank God. The question was on refinance for larger properties. What do they look at? What are they looking for? How much do they dive into it? How many units do they need to go tour? Just give us a quick overview of it. Josh.
Sure. So we're actually in the process of our second right now, refinance-wise.
How big are those? Or how big is that?
So we had 62 we did, and then 80 doing right now. In unit size, the amounts were $1.5 million for the first one, and this is going to be about $3.5 million. We haven't had any appraisal issues, so I can't really speak to that. I do think you can make the case. I don't know. I can't say I've been successful or have attempted that side either way. From an inspection perspective, it's quick. They look for really just a sample. They're coming out there and trying to get into a handful of units, whatever that may be, 3 to 5 units. What else was involved in that question? So you have to be careful about that.
Yeah, that's called mortgage fraud.
Yeah, so just for
no, it's
so on the. Is it even working? Yeah.
It's like, oh yeah, it's making 137 grand. It's a 4 cap.
Yeah. So
Totally.
to that point, I mean, you're trying to capitalize expenses. So if
Right.
you're doing a renovation on a unit and you're replacing an appliance, you're putting that below the line, right?
Yes. So we're doing it right now on a 122 unit. We had a conversation with Ben, who I introduced you to, and he looked at him, and we did a ton of work. We renovated about 70 units in the first year. So we had an extra maintenance guy at the property while we were doing that. That's something we could capitalize because we had a guy there doing turns. So we took that salaries and wages and we moved it as a capital item. So you can work with the right lenders. You look at a local bank, it's never going to happen. They have their ways. It is what it is. You work with a better group, they will look at your financials. That's what your mortgage broker or originator, that's what he's there for. He's there to help that loan get through. You can't scrap out half of it. That's illegal. But if there's a capital, like Josh is saying, if you're doing appliances and you got to capitalize in the wrong place, drop it below the line because that's not something that's going to be reoccurring. We have a trash contract on a property. The trash bill is $5,000 a month, or even higher. It was like $6,000 a month. So we just terminated that contract. We paid $20 grand. Our trash contract's now $1,100. So we sent them the termination contract. So they took it out of the financials because it's not going to be reoccurring. So you can work with them. If an appraiser comes out and nails you, it's over, right? You might have to get another appraisal. So you could pay for another appraisal, but that's what we've seen.
But I thought the bigger deals are driven by cap rates, not just set on an appraisal now. Because what if an appraiser comes in with a number that's not really accurate based on the cap rate for that area?
It goes both ways.
Yeah, and I mean the appraisal, you're not getting like a $500 appraisal. You're getting, they're taking into account sales comps, they're valuing NOI, they're discounting to location. So, I typically the appraiser that we had most recently, he asked me what my refinance amount was. So whether you're supposed to do that or not do that, they are working within a margin of error where I don't think most appraisers are trying to hurt you. They're just trying to.
That's on video. We're sending that to the mortgage company.
That's fine. It's a part. I don't think there's anything.
No, Josh is right. It's not like residential where it's they got to they're gonna kill you. On the commercial side, he's right. I mean that's a lot of times when we use a mortgage broker. It costs us money, but they look at it first and they will argue on your behalf. Wait a second, you're discounting this comp. So it is cap rate driven, but it's also everything driven. It's not just this is a 6 cap market. We're gonna 6 cap your bullshit expenses. They're gonna take into consideration market expenses, market rent, location, property sale, per door. They're gonna take it all into consideration and they'll come up with a value. If you're off 20 grand, they'll work with you. If you're off 7 million, it ain't gonna happen.
So the value you guys got to calculate the
It's a huge part of it.
Yes.
It's a huge part of it. But that appraisal takes into consideration cap rate, takes into consideration all of that.
Usually all term sheets are contingent upon a base appraisal value, which is usually what it's based on. So appraisal comes in at least X to be able to move forward.
Yeah, they'll give you a term sheet. They'll say, we'll give you $1.5 million based on an appraisal. If you want $1.5 million and the building appraised at 800, it ain't gonna happen.
I refied 13 units 4 years ago, and the properties were doing so well that they couldn't give me the cap rate for the area. I would be like 20,000 per unit over, and they hit me because I would be leading the pack. So they actually gave me this super high cap rate. So I had to argue with the bank, and they actually ended up giving me a business line of credit to equal out what I was looking for based on the true cap rate of the area. But that goes into, like, the appraisal came back, and the appraiser was just like, I can't give you this amount.
Yeah, that's another. We did that too. We got a building that we got a loan, and then we also got a line of credit from the bank because it was a way for them to get around the value.
Right.
And so that's try that too. Try and see if they'll give you a business line of credit for the difference or for the value.
And that business line of credit is service how?
It would.
Coming with the property so strong to get it from one.
Well, because like basically at the time Syracuse was like a 9 cap or something, a 9 or a 10 cap, and they would had to have given me like another 200 grand. So they gave me they pegged it at a 13 cap to give me what the appraiser thought the comps were. So they gave me a business line of credit to equal out what I was going to get at a true market 10 cap, and they made it a second to themselves.
All right, I think we had two more questions, and then we're gonna call it for that time.
I also had to argue with the bank on that one.
We'll do Tom over here.
Okay.
So like raising funds and all that, somebody that has never done it before, what is the process? What should we have in like package or whatever the case, Chris, you were saying you raised $5 million in like a month. How did that come about?
Well, there was go ahead. Yeah.
Question, which I think again we could probably do a whole hour on.
We will. We'll do a monthly event on raising money.
Raising money. If you've never done it, how do you get started? How do you put a package together? How do you start that whole boat? Try to limit it a little bit.
I'll go quick. Okay, so me raising $5 million is going to be a different conversation than how I started. Okay, like I started with friends and family. So I started there, got my track record going, and then when you raise $5 million, it came from another group that gave a large amount, but that was from like 10 years of experience that I could show. But mainly it's about your network. I networked a lot, create relationships, and tell people what you're doing, and tell them about your track record.
Totally agree. It's been just growing slowly. My largest investor to this point is someone that I met 7 years ago, never invested in anything, and then last year invested a lot. So I think that's it's very difficult to just get started in real estate and raise enormous amounts of money. I think that's out there, that concept, but it's not the reality. It's going to start within whatever your relative comfort zone is. It certainly helps to have a rich uncle that's got your back. But if not, I think you're starting by pooling together a handful of people that are like-minded, that share the same vision, if that's the goal.
The first thing I would do, obviously on the legal side of it, before you do anything, just make sure you're doing it the right way. So just speak to an attorney. Chalk it up as it's going to cost you money, but make sure you go about it the right way, because you don't want to start blasting out emails and doing it illegally. Mm-hmm. The next thing I would do, an exercise that I think works really well, go through your phone A to Z, put a number next to someone's name that you think they would invest, and then start calling, right? Just get on the phone. Hey, I want to take you out for coffee. Don't call them and say, hey, I want 50 grand. Say, hey, let's get a cup of coffee. And you also have to educate your investor base, potential investor base. They know you as Tom, I do this. You got to start today for money you want to raise in 6 months by educating them. I am looking for real estate. I've toured these deals. I own property, and you want to educate them. So when the deal comes time for it, they're prepared, and it's not just cold asking someone for money. Offer them an opportunity. Don't ask for money. Hold on, he had a question, then we'll ask one more.
All right.
I'd like to know from each one of you how you sourced your biggest deal and how was the negotiating process and how long it took.
So question was for each person, biggest deal you sourced, how did you source it, and how long did it take to close?
My biggest one was the most recent one, $11 million, 174 units. I found it from a broker off market, but I called the broker. It was with another group that had it before us, and I felt like it was going to fall out, like that other group wasn't going to be able to take it down. And I called the broker every week for 2 months, asking when it was falling apart.
So did you price it per door?
Hmm?
Or how did you price the deal?
I mean, it was a $10.8 million deal. It turned out to be something like $62,000 per door, and that it took 3 months. Took approximately 3 months to close.
What are the rents?
The rents started out at $734 as average rents, and we are hitting $1035 and $935 for 2 beds and 3 beds right now. So there's about $150 per average rent per month delta.
What was the due diligence time for something like that?
It was about 30 days.
Josh?
About an $8 million deal a couple years ago in Charleston, 96 units. It actually never went to market. It was off market. Broker I've known for a while. Worked with just in other capacities as my previous role on the acquisition side. And he knew I was in this space, and I was one of a handful of buyers that he called and gave the look at for the deal. And I was able to move quickly, like Chris said, and just act, and we were awarded that deal. It was probably 90 to 100 days or so, and 30-day diligence as well.
Our biggest deal was the deal we just closed. It was 3 properties, so it was a portfolio. It was $39 million. It was two different sellers. One was sourced by our property manager. She brought it to us saying, hey, they're looking to buy. So she wanted to retain management. So she brought it to us. And then the other deal was sourced by a broker on market, nothing exclusive about it. They missed their price, and we sort of just stayed in there and gave them their, we were like the 4th or 5th highest offer. So they missed, and we were just there, and we really wanted to get active in Jacksonville. So we offered on that to shake the trees loose. Then the 2 other deals came. The 2 other deals closed in, 65, 70 days from start to finish?
About
and those
70.
Those were 30-day due diligence. The other deal
75.
took 7 months because there was just, you name it. They were in a 1031. We were in a 1031. There was an extension here. There was a title defect. There was just a plethora of things that went wrong, but it took 6 months, give or take, 7.
Something like that, yeah. Last question in the back, and then we're going to call it.
It's a one-off question.
Okay. All right, awesome. We're going to call it there just for time. I know other people have questions. I appreciate you sitting throughout the whole thing. I appreciate you putting up with some of the technical stuff as well. We have the room until 10, probably a little bit past if you want. So coffee and water in the back if you didn't see it already. Thanks for coming, and make sure you come say hello before you leave.
Thanks
guys.
everyone.
Thank you.